This hearing will come to order. This hearing is another remote hearing by video and a few of the traditional video conferencing reminders again. Once you start speaking, there will be a slight delay before you're displayed on screen. To minimize the background noise, please click the mute button until it is your turn to speak or ask questions. If there is any technology issue, we will move to the next senator until it is resolved, and I remind all senators and the witnesses that the 5-minute clock does still apply. You should all have one box on your screens labeled clock that will show how much time is remaining, and I will try to remember to gently tap the gavel to remind senators about 30 seconds before their time is up. To simplify the speaking order process, Senator Brown and I have again agreed to go by seniority for this hearing. With that, today we welcome to this virtual hearing the following witnesses. Mr. Hal Scott, President, the Committee on Capital Markets Regulation. Mr. Jeffrey DeBoer, President and Chief Executive Officer of the Real Estate Roundtable. And the Honorable William Spriggs, Professor of Economics at Howard University and Chief Economist of the AFL-CIO. It's been 5 months since the passage of the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act, and it's being signed into law. Title IV of the CARES Act provided $500 billion infusion to the Exchange Stabilization Fund in order to support the Federal Reserve's emergency lending facilities. This amount has been leveraged to provide trillions of dollars in liquidity back into the markets, supporting credit flow and helping to stabilize the economy. Currently, there remains about $250 billion left from the CARES Act funding. Today we'll receive testimony from each witness providing an update on the Federal Reserve 13.3 emergency lending facilities, including recommendations on how the Main Street lending program and the Municipal Liquidity facility could be changed to improve access and demand for the programs as we move forward. We will also hear an update on the state of the commercial real estate market, why the CRE market lacks access to needed support, including through Main Street, and recommendations for options to get support to commercial real estate. The Federal Reserve established the Main Street facilities to support lending to small and medium-sized businesses and nonprofit organizations that were in sound financial condition before COVID-19. The Main Street program includes 5 facilities: the Main Street New Loan Facility, the Main Street Priority Loan Facility, the Main Street Expanded Loan Facility, the Nonprofit Organization New Loan Facility, and the Nonprofit Organization Expanded Loan Facility. Treasury's equity investment of $75 billion into the Main Street program is estimated to provide up to $600 billion in credit to eligible businesses. However, there has been broad concern around the lack of broad access to the Main Street program, and so far its uptake has been slow. One of the most significant industries to lack access to Main Street is the commercial real estate market. On July 31, I sent a letter to Secretary Mnuchin and Chairman Powell urging them to quickly expand the Main Street program by setting up an asset-based lending facility and to address commercial real estate either through access to the Main Street program or in a separate facility. During this hearing, I look forward to hearing more about the state of small and medium-sized businesses in industry across the U.S. and their access to financing, additional ways that facilities could be improved and expanded to provide access to more industries, and recommendations for the use of the remaining Title IV funds. As I noted in the hearing on Title IV implementation this committee held on June 2, I'm still concerned that incorporating widespread restrictions in these facilities could render the facilities ineffective and leave businesses and their employees without critical resources they desperately need. The work to get these facilities up and running has been of immense importance, and now it must be ensured that they are structured to achieve the greatest impact for those in need. I appreciate each of you joining us today to share your perspective on these important issues. Senator Brown.
Thank you, Mr. Chairman, and thank you to Professor Scott, Professor Spriggs, and Mr. DeBoer for joining us. More than 150 years ago, President Lincoln observed, "It has so happened in all ages of the world that some have labored and others have, without labor, enjoyed a large portion of the fruits. This is wrong. It should not continue. This pandemic is revealing just how true Lincoln's words are today. This week we celebrate Labor Day, a day when we honor the people who make our country work. All workers, whether you punch a clock or swipe a badge, whether you work for salary or work for tips, whether you're taking care of an aging parent or raising children, all workers. But workers deserve more than empty words in a tweet or in an email message. For months, we've seen advertisements and PR campaigns from big corporations proclaiming how dedicated they are to the essential workers that keep our country running. But statements that aren't followed up by increased pay or safer workplaces ring hollow, whether they're from companies or from government officials. This Labor Day, this country isn't living up to its promise to workers. Whether it's ending a month ago the $600 a week unemployment insurance that kept millions of families afloat, or just the simple promise that families won't lose their homes in the middle of a pandemic. Under President Trump, our government has given up on its support of our workers. We are on the precipice of another Great Depression. If you have the privilege to work from home and you've been watching your stock portfolio slowly rebound, you're thinking right now, this guy's being alarmist. I have news for you. You don't understand the real economy. No matter how well the stock market is doing, no matter how high bank profits and corporate profits are, if workers cannot work, and I say cannot work, not won't work, because workers are desperate to get back on the job safely, then our economy can't work. The president's failure to get this pandemic under control is keeping tens of millions of Americans who want to go to work sitting on the sidelines of our economy. If people can't go to work, if they can't pay their rent or their mortgage, if they can't pay their car payment or credit card bills, the bottom will fall out of this economy. It's been over 6 months since we passed comprehensive coronavirus relief for working Americans, as the chairman said. But because of the president's failed leadership, things have only gotten worse. He's allowed the virus to rage out of control. Nearly 190,000 Americans have died in less than 6 months. You all know the statistics. We're 4% of the world's population. We account for 22% of the world's deaths. School districts have been forced to make impossible decisions, reopen and put students and teachers and custodians and cafeteria workers at risk, or continue to teach remotely, putting an unbearable load on working parents and widening the achievement gap. State and local governments try to step in and help, but their tax revenues are down because taxpayers have lost jobs. Businesses had to cut back, operate with fewer customers, or shut their doors. That's only going to mean more layoffs of good middle-class jobs, extending this cycle of misery. After Leader McConnell and President Trump allowed the $600 expanded unemployment benefits to expire and refused to pass additional stimulus checks and refused to pass housing assistance and refused to support local communities, the emergency lending program we're talking about today, they're the only programs left operating to prop up our economy. And none, as Mr. Spriggs will point out, none of these Fed lending programs are actually helping workers. Dividends are still getting paid. CEOs are still getting their salaries and bonuses. The stock market continues to get a lift. So if you make your money from a brokerage statement, the government's still helping you. In fact, you're pretty much the only one the government's actually helping. That help does not trickle down from big banks and corporations to the people who make their money from a weekly paycheck, the vast, vast majority of the American public. It should be obvious to everyone by now that those benefits to the wealthy never trickle down to the workers who make this economy run. They didn't with the corporate tax cut 2 years ago. They aren't now. Instead, these programs help corporations, many of which continue to lay off workers and have cut hazard pay for those who are still risking their lives on the front lines of this pandemic, even if they even bothered to pay those workers hazard pay to begin with. Mr. Chairman, we're going about this backward. Every dollar we give to working families goes directly to supporting the real economy. When those families pay their rent and their bills, when they buy groceries and school supplies and spend monies at local businesses. In fact, if we put families and workers first, if the Senate would actually do that, if the president cared enough to put families and workers first, we wouldn't have to bail out corporations at all. The market that so many in this committee profess to put so much faith in would take care of that. Of course, we know our economy will not fully recover while the virus is still not under control. The CARES Act that we passed in March was designed to be temporary relief, to get our workers and their families through the immediate economic hardships while we marshaled all our country's vast resources and talent to stop a pandemic. Clearly, the president failed to do that. Now, what we thought would be a relatively short economic disruption has dragged on month after month after month with no end in sight. We still have no mask mandate. We still have no national testing strategy. We still have no effective contact tracing. We're seeing another resurgence across 22 states. And as I said, 4% of the world's population, 22% of the world's deaths. Imagine, Mr. Chairman, and particularly the Republicans on this committee, imagine if the president back in March, instead of dismissing the virus as it will go away, had taken this seriously. Imagine if he'd said we should all wear masks. Imagine if he had modeled good precautions we should take. Imagine if he said we're going to mobilize Americans' manufacturing talent and make enough tests to test every public school by the summer. Imagine where we would be as a society right now. Instead, the president's simply given up on controlling this pandemic at all until a vaccine is developed. Given the scale of his incompetence and his failures thus far, we can only assume he will fail just as badly at distributing a vaccine once that day comes, if he's still in office. The economy won't recover until this president and his cabinet and his friends in Congress take governing seriously. Later this month, Mr. Chairman, we'll have a hearing with Secretary Mnuchin and Chairman Powell. Unlike today's hearing, that one will be conducted in person. That's because the president has told his top officials they must testify in person in his continued attempts to gaslight the American people about the danger of the virus. We should be conducting, as you've done, Mr. Chairman, whenever you can, all hearings remotely, not just to protect senators and administration officials, to protect the cafeteria workers and the custodians and the staff at this Capitol, the police officers, all who are forced to show up and put themselves at risk. Then they worry that the anxiety when they return home that they may spread it to their families. 6 months of failure. I'm honestly surprised, Mr. Chairman, been here a long time, but I'm honestly surprised that the president's friends in Congress continue to let him get away with it. Mr. Chairman, we need your help. We need your leadership. You've done the right thing by conducting our hearings remotely. We need you to demand to the White House, send the right message about taking the coronavirus seriously. Tell Secretary Mnuchin he needs to testify remotely. I have no doubt that Chair Powell would be happy to do so if asked. And Mr. Chairman, we need your help, and we need everyone on this committee's help in convincing Leader McConnell to extend direct support for families while we fight this virus. The House has passed a bill that would take care of workers and renters and homeowners and students and veterans and seniors and local governments. We all know this, shall we say, emaciated McConnell proposal isn't going to help these families keep food on the table. When something isn't right, we speak up. That's the job we signed up for. Right now, thousands of people are dying every week in this country, and Republicans are not speaking out. The best way Congress could celebrate Labor Day is by doing our job. We need your help to tell President Trump and President McConnell and Leader McConnell it's time to do their jobs. Let us get back to work. We've wasted far too much time already. Thank you, Mr. Chairman.
Thank you. We'll now move to our witness testimony, and we will begin with that in the order I introduced you. So we will begin with Mr. Scott. You may proceed.
Thank you, Chairman Crapo, Ranking Member Brown, and members of this committee for inviting me to testify before you. My focus is on the Treasury Federal Reserve Main Street Lending Program. And my testimony today regarding Main Street is based on the September 3 statement of the Committee on Capital Markets Regulation, CCMR as abbreviated. With respect to other issues, testimony is my own and does not necessarily represent the views of my committee. CCMR believes that small and medium-sized businesses will need financial support for several years to recover from the impact of the COVID-19 pandemic. While our economy is improving, given the depths to which it fell, there is still a long way to go. Small business revenues continue to be well below pre-pandemic levels, and the recovery has stalled since July. A key part of this financial support should come from the Main Street program authorized by the CARES Act. So far, the 3 for-profit business facilities of the Main Street program, which have been operating for over 2 months, have fallen far short of their desired results. Secretary Mnuchin has estimated that between 25 and 50 billion in loans will ultimately be issued through Main Street, significantly below its existing lending capacity of 600 billion and what is actually needed for economic recovery. CCMR has therefore recommended that Main Street be significantly restructured to take on more credit risk by providing that the Federal Reserve make 100% of each loan rather than 95% as presently provided, leaving banks and other eligible financial institutions as processors. If banks take on any loans or any portion of a loan, they will apply normal credit standards that many needing businesses cannot meet. Secondly, these loans should be at below market rates, lower interest rates, and longer maturities, coming close to equity without actually requiring capital restructuring. Congress has already appropriated $454 billion in the CARES Act to back Fed lending facilities. Depending on how one counts, $251 billion or $351 billion if you look at money that the Secretary has said that if you subtract money that the Secretary has said he would commit but hasn't committed, there's actually maybe $351 billion available. And much of this, of course, remains unused and could be used to provide additional backing for Main Street. It is critical that the Fed and Treasury revise and deploy the Main Street programs now, as the congressional authority for the Fed to make new Main Street loans likely expires on December 31st under the CARES Act. The Main Street loan should be made on a first-come, first-served basis based on available data and objective criteria to ensure that the government is not picking winners and losers and that the prospective borrowers have a reasonable chance to survive. And loans should not be available to businesses that can get market rate funding from their own banks. The Fed must also, and this is quite important, reach out to the hardest hit and underserved communities so that they can take advantage of the program. It is indisputable that small and medium-sized businesses, the backbone of our economy, have been very hard hit. A V-shaped recovery, meaning that the economy will within the next year bounce back to pre-COVID levels, is unlikely. According to the latest economic projections from the Fed, the economy will contract by anywhere between 4% and 10% this year. Most officials do not expect the economy to recover completely until 2022. While the latest unemployment figures have improved, the level is still very high at 8.4%. And as Chairman Powell observed last week, there are still 11 million fewer Americans working than there were in February. CCMR specifically recommends that Congress enact Senator Crapo's proposed amendment to remove any doubt that Congress's intent in enacting the CARES Act was for the Treasury to take credit risk. If such legislative action cannot be achieved, we would recommend that the Senate Banking Committee clarify Congress's intent in a bipartisan letter to Secretary Mnuchin. There is no guarantee that our recommendations will succeed in saving American small and medium-sized businesses. But the current approach has been tried and found wanting. Our recommendations would give many of these businesses a fighting chance. The time to act is now. Thank you.
Thank you, Mr. Scott. Mr. DeBoer.
Morning, Chairman Crapo, Senator Brown, and members of the committee. I want to start by simply thanking you, Mr. Chairman, for your reference at the start of the hearing about the need to address commercial real estate and the problems that our industry is having on the rest of the economy. I also want to thank Senator Brown for your focus on the need for rental assistance for individuals and families. That's very, very important. And finally, I would like to comment that Senator Warner and Senator Toomey and other members of this committee were very instrumental in trying to create a very good program, the Main Street Lending Program. I'm here today on behalf of the Real Estate Roundtable and the 19 national real estate trade associations that are referenced in my written testimony. People out of work and businesses shuttered and denied income for months have suffered immensely in this pandemic through no fault or action of their own. Many of these people and businesses have struggled to pay for food, struggled to pay for housing, and struggled to pay for the rent for their businesses. For owners of apartment buildings, retail facilities, hotels, office buildings, senior housing, and other buildings, the situation is dramatically affecting their ability to pay their payroll and causing layoffs of building maintenance and security personnel for them. It is impacting their ability to meet their debt service obligations, which increases pressure on financial institutions, pension fund investors, and others. And it is pushing property values down to the detriment of local governments. It's causing much stress in pools for commercial mortgage-backed securities. It's threatening to result in countless commercial property foreclosures. The situation must be addressed. I want to thank Congress and the administration for the quick, deep, bipartisan COVID relief action taken this past spring. Without that action, the situation for the nation's economy would be much worse. But many of those programs, as well-intentioned and desirable as they are, did not reach beyond a relatively narrow definition of small business. That role was left to the well-intended Fed-administered Main Street Lending Program. Its goal was to provide capital to mid-sized businesses with COVID-related economic problems that can't obtain capital elsewhere. Unfortunately, as Mr. Scott just mentioned, the Main Street program is not lending. The result, countless mid-sized retail businesses, restaurants, hotels, commercial, multifamily building owners are moving closer to shutting their doors forever. As these Main Street businesses run out of reserves, they miss their rent, utility, and tax payments. They furlough and lay off employees. They begin to look to bankruptcy and abandonment as solutions. The Main Street Lending Program is simply far too risk averse, as Mr. Scott said, to respond to the rapidly developing conditions for many Main Street businesses. These Main Street businesses need assistance now. They are risky, but not because their product or their business line is risky. They're bearing a huge, somewhat immeasurable new risk that is based on governmental policy, the ability to keep clients, customers, and guests healthy, in particular, the timing of finding a vaccine. These are the businesses that Congress wanted the Main Street Lending Program to serve. They can't get capital elsewhere. They are disproportionately minority, women, and veteran-owned businesses, and they are increasingly running out of options. Why? Because there's no incentive for banks under the program to market these loans and make the loans. In addition, the program's eligibility, affiliation, and underwriting rules are not designed to meet the needs of the businesses that increasingly need this assistance. Both of these problems could be addressed administratively without additional appropriated funds. We should move, as was suggested, the loan, 100% of the loan, instead of 95% of the loan, should be moved to the Fed. The bank should continue to service the loan to maturity, and like a pool servicer, it should be compensated by the bondholders, in this case, the Treasury Department. Perhaps regulators should be instructed not to criticize banks to make Main Street risky loans, as they currently are criticizing them. Incentives for banking a loan won't solve the problem, though. Administrative action is also needed to reform the mixture of misapplied small business administration lending eligibility rules that bar assistance, for example, to any commercial real estate business. We need to deal with inappropriate leverage limits that hamper the usefulness nearly to all retail stores and restaurants. And the underwriting rules that are in place now simply do not work for any asset-based borrower, whether that's a manufacturer, a restaurant, a retail, a commercial, or multifamily owner. We need incentives and we need eligibility rules that make sense. Congress, though, should take more action as well. We urge that Congress provide additional rental assistance to residential and business tenants. We think that the tax code should promote healthy workplaces. We want to facilitate debt workouts. There's going to be a tremendous amount of debt on all kinds of businesses that will need to be worked out. We need to provide reasonable liability protection against COVID lawsuits that are unnecessary in many cases. And we need to develop a federal pandemic risk insurance program. These actions are by no means simple and by no means small. We understand that, but together they will help America's families and businesses recover, and they will allow this job creation to move forward. Thank you, and I look forward to your questions. Thank you very much.
Thank you, Mr. DeBoer. Mr. Spriggs.
And Ranking Member Brown. Did I mute? I'm sorry.
You're on now.
Okay, thank you. I apologize. Thank you, Chair Crapo and Ranking Member Brown, for this invitation to give testimony before your committee today on the issue of where the economy stands with the status of the Federal Reserve's emergency lending facilities. I'm happy to offer this testimony on behalf of the AFL-CIO, America's House of Labor, representing the working people of the United States, and based on my expertise as a professor in Howard University's Department of Economics. We began this year with the world facing a novel virus for which we lacked adequate cures, and that proved more deadly than most flus we had encountered. The lethal potency of the virus and its easy spread required a new set of responses. Given the lack of a cure and its costly nature of care on people and health systems, the world adopted a policy of social distancing and isolation to prevent its spread. This policy proved very effective in reducing deaths, and for the nations that took aggressive measures, like New Zealand, proved highly effective in ending the virus's threat. But despite the huge economic benefits of these policies, and they are huge, slowing the economy to carry out social distancing had huge costs too. By all measures, the benefits of saved lives alone far outweighed the cost of slowing the economy. It's important to note that in the United States, where our implementation of social distancing policies was very uneven, it is also clear that the uncertainty of COVID itself slowed economic activity. The United States policy variation is clearly documented that social distancing policies are not the driver of the economic slowdown, but the spread of the disease is the cause of the economic slowdown. The difference is in the efficacy of the policy in slowing down the virus. This virus caused great decline in economic activity, and the world responded in new and novel ways. Thankfully, the United States Congress took early action to sustain the economy, passing the Family First and the CARES Act, and this bought time for policies to contain the virus to take hold. Unfortunately, while the economic policies were effective, the policies to contain the virus in the United States have lagged those of other countries, so our economy now enters a new phase of high uncertainty because of COVID without the aid of those earlier bold actions. In March, the uncertainty of COVID slowed certain economic activity in the U.S. That led to the first month of job loss in March, and in April brought the most dramatic loss of jobs in U.S. economic history. In that 1 month, we lost more than twice the jobs lost over the course of the Great Recession. While other advanced economies planned for social distancing by massively subsidizing payroll, America chose to dump workers into unemployment insurance systems. Rather than subsidize payroll, we chose to try and subsidize workers within the unemployment insurance system. To approximate pre-existing payroll, an additional $600 was added to weekly unemployment benefits. This policy choice might have worked the same as with other advanced countries if COVID were put under control and sufficient economic certainty was restored for households to resume normal consumption. However, there are many challenges to using the U.S. unemployment insurance system. It really was not designed for this. Our nation's unemployment system laws don't cover the workers that were most affected. In 2018, only 8% of those in leisure and hospitality received unemployment benefits if they were unemployed. And at the peak of the Great Recession, the system only needed to handle 3 million people. That was in May 2009, but at the end of March, it was receiving 6 million applications weekly, and 4 weeks, it averaged above 3 million for 7 weeks, April to May. Congress also granted the Federal Reserve funds and unprecedented latitude to devise policies to maintain liquidity in the capital markets. You have heard two great testimonies ahead of me on the problems that the U.S. Treasury imposed on those funds, limiting their access to minority firms and to make the program unable to absorb the risk that was needed in a time of high uncertainty. I won't review those comments. I will add one additional, and that's a concern to broaden the ability to lend to public entities. I want to instead concentrate on the problem facing households. And looking at the problem facing households, we are in a foot race against people being unable to make the payments in the real economy that sustain rent, that sustain investment, that make it possible to pay the loans that are owed. Please remember, it's the real economy that matters. That foot race that we are in right now, we are behind because of the lack of support to households. And without that support, we face calamity.
Thank you, Mr. Spriggs. I'll go with the first question today with you, Mr. Scott. And my question really relates to the success or lack of success, in your opinion, of the Main Street facility and the other 13-3 facilities in terms of making capital available to the stressed businesses that need it. I understand the testimony of Mr. DeBoer and Mr. Spriggs about the real estate industry and the minority businesses. And I understand their testimony that those particular sectors have not been able to benefit from the Main Street facility or other Fed facilities. I'm also aware of a point of view that the other Fed facilities that have been established, like the primary market corporation credit facility and the secondary market corporate credit facility and the term asset-backed securities loan facility and others, have had an impact in terms of making private sector capital more available to many businesses. So the question I have is, is the issue of access to these funds a sectoral issue, one related to real estate or minority businesses or others? Or is there still a broad-based lack of access to the necessary capital by companies that just can't get that credit in the private sector?
I think, for the capital market facilities that were extended to companies issuing bonds for existence, those have been very successful. They haven't had to lend very much money because the fact that they would be prepared to lend the money actually steadied the markets so these companies can get the money in the private sector. That is not the case for Main Street. Small, medium-sized businesses don't access capital markets, okay? They get funding from banks. So there is where the access issue really, is important. And as I testified, I think it's not that the Main Street facility was designed to exclude certain industries, although I agree with Jeff that, in certain cases it might be that the criteria that were established effectively excluded certain businesses from getting access. But they weren't designed to just support certain sectors of the economy. They were designed to support the entire economy. The problem with the facilities, as Chairman well knows, due to his amendment, is that these facilities were not designed to take on credit risk and for Main Street. And that's in two regards. First of all, as I said in my testimony, if you say the banks have to take 5%, they're going to apply normal credit standards, and needy businesses are not going to get the money. And secondly, the terms, were difficult, 3% interest, short maturity, and so forth. So I don't think it's a general discrimination against sectors. I think it's more of a question of the design of the program, what the criteria are.
All right, thank you. And I'm running out of time a little bit already, but
I'm sorry for that long-winded answer.
no, it was a long answer. It was a long question too. But Mr. DeBoer, maybe I would go to you next. And in the minute or so I have left, minute and a half maybe, could you just respond, both you and Mr. Scott, in your description of what needs to be done, had some pretty significant overlap in terms of how we could improve the Main Street facility. And rather than focus on where you may or may not have any disagreements, could you just, again, quickly summarize what do you think needs to be done in terms of making the facility more available in your world?
Thank you very much. First of all, banks are not incentivized to lend under this program. They have a 5% retention on the loan, and they're underwriting under basically under traditional underwriting criteria. Well, traditional underwriting criteria would say these are risky loans. They get criticized by regulators for doing that. They have the risk of the 5% loss, even though we know that these are risky loans. So we share the view that 100% of the loan should move to the SPV, the Fed facility. We share the view that maturity should be longer, I believe. I think we share the view that amortization of the loan should be delayed a little bit longer and occur later on in the life of the loan. And I believe that we share the view that the underwriting rules, for example, requirements that tie the loans to EBITDA or that tie the loans to a certain leverage ratio need to be revisited because they simply do not respond to these risky businesses. EBITDA means nothing when you have no income. And so there should be more traditional lending criteria that accommodate asset-based borrowers. So you have loan to value, or you have loan to cost, or loan to receipt, something that is different than what we have now. So incentivize the banks and broaden the eligibility. And in terms of, just one more second, in terms of the eligibility and certain sectors, the administration and the Fed lifted the SBA eligibility rules from their traditional SBA program and suddenly decided that that should be the applicable eligibility rules for a Main Street lending program, which bars certain companies and businesses. Certainly real estate are barred. And there is no reason for this, and I don't believe that Congress intended that for this program or, frankly, for the PPP program where they did the same thing.
All right, thank you. My time is up. This is helpful. Senator Brown.
Thanks, Chairman. And Mr. DeBoer, thank you for speaking out twice, I think, in your testimony for emergency rental assistance. And many of us fear a wave of evictions in the coming weeks because of the expiration of the unemployment benefit. Dr. Spriggs, Mike, I'll start with you. If we continue to depend on these Federal Reserve emergency facilities rather than providing direct support to working families, what do you think happens to the economy over the next several months?
Well, we're in trouble. We're in a foot race right now. As Chairman Powell pointed out, and the data we got last Friday point out, we're down over 11 million jobs from our peak. That's worse. So today we're starting at a worse position than the depths of the Great Recession. We are not creating jobs at a fast enough level to clear that backlog. And so we see a rise in long-term unemployment. We see a rise in the job losses that are permanent job losses in tandem with what we saw during the Great Recession. So we are in a foot race in our economy because what we're trying to do is outrun the debt of the household sector. And we can only do that by putting money into the hands of workers so they can pay their rents, so that they can support the small businesses, so that the small businesses can pay their rents. The way to help the economy is to help the real economy. We have to pump back into the system the money that we are losing from the loss in payroll. Other countries did that by maintaining payroll. We agreed that we would do that by maintaining unemployment insurance. That $600 is necessary to keep that and so that we can stay in step with other advanced economies. And without that, we're going to face massive problems for loan holders when it comes to commercial real estate. The way to solve it isn't to help the banks at the end, it's to help the real economy on the front side and have workers have the money to pay the rent. Even with eviction abatement, you got to remember that people are still accruing the debt of owing that rent. So eviction help is necessary to keep them from being homeless, but we also need help to make sure that they have the money to pay the rent.
So make sure I understand it. If you'd answer this question, yes or no, because I have something else I want to ask you. To avoid another Great Depression, Congress needs to take action to provide direct help to families, workers, homeowners, renters, in other words, regular people, correct?
That's correct.
Dr. Spriggs, after the 2008 crisis, despite spending trillions of dollars to rescue the economy, as we know, millions of families lost their homes, banks got larger, banks made record profits. Why did that happen? How do we avoid, two questions, why did that happen a decade ago? And second, how do we avoid that from happening during this crisis?
We concentrated so much in the last crisis on financial stability and thinking the Fed can solve all problems. The Fed can provide liquidity to keep the financial markets healthy and to make banks healthy. But that ignores the other part of the national balance sheet, the assets of the banks being the loans. We protected that. We didn't help households with the liability side. So what we did was we built a life raft for the banks, and it pulled away, and the rest of us were sinking in the storm. We must help the household sector, and we have an opportunity to help the household sector now, but we will lose that ability if we don't help the household sector and we're confronted with banks holding bad loans and facing collapse because they're holding too many bad loans.
Let me ask one other question. Thank you, Mr. Chairman. Dr. Spriggs, I have sat on the Senate floor and heard my colleagues talk over and over about, my millionaire colleagues and billionaires in the president's cabinet talk about we're giving too much to workers, unemployed workers. This unemployment insurance is a disincentive to return to work. I think they're wrong. What do you think and why?
Well, during the period that people were getting it, there were many studies to look at that exact issue. They found no negative effect. And then we had August where no one was getting the money, and we had final proof. There was no disincentive effect because we saw nothing happening with labor force participation to indicate that the $600 was keeping people out. What's keeping people out of the labor force is the availability of jobs at this record level of unemployment.
One study, Mr. Chairman, showed that the unemployment insurance kept 12 million people out of poverty. And I applaud my colleagues in both parties for passing that $600 a week, which literally kept people from being evicted, kept them in their homes, kept the economy going, kept the banks in business, helped everybody. And I'm just sorry that my colleagues don't think that's a key part of this recovery and addressing the bad economy we're living in. Thank you, Mr. Chairman. Dr. Spriggs, thank you. Mr. DeBoer, Professor.
Senator Timmy.
Thanks very much, Mr. Chairman. Thanks for having this hearing, and special thanks to Professor Scott for the conversations that we've had and the thoughtful contributions he's made to the discussions about these programs. I want to take a few moments here to suggest some context about the Main Street Lending Program, Mr. Chairman. And let me start by saying I think it's still too soon to call this program a failure, much less citing it as a failure that justifies then some new big programs. And let me explain why. There's several reasons. First, let's remember this is still a relatively recent program, for better or for worse. I think the first loan was made in early July, and there is now very recently a big increase in the pipeline. I'm not suggesting that I think the program is on track to be utilized to the extent that was contemplated, but there is an acceleration of utilization. But maybe more importantly, it's entirely possible, and I'm still trying to get the data to determine this, but it's entirely possible that businesses that were intended to participate in this are simply accessing credit elsewhere. According to the NFIB's July 2020 report, they said, and I quote, "Historically, loans have never been cheaper," end quote. In their August report, they say the NFIB, among their membership, which is the largest small business organization in America, probably the world, they say that only 3% of business owners surveyed said that all of their borrowing needs were not satisfied. That's pretty interesting. And let's remember, the Fed, we have thought of this as a lender of last resort, and it is not a failure if it turns out that other lenders, private lenders, have been stepping in and providing the credit that's been needed, whether it's banks or BDCs or other institutions. I've also heard, at least anecdotally, there are banks that suggest that they've been able to offer better terms to borrowers than the Main Street program. Again, if that's what's happening, that's not necessarily a failure. I think it's also important to think about where we are today compared to where we were when the CARES Act was passed. The CARES Act was meant, in my view, to resolve an immediate and very, very dangerous and frightening liquidity crunch due to the economic shock that we were experiencing back in March, April. It was meant to bridge this liquidity need for a fundamentally solvent business to get through what we hoped would be a very short, though certainly very severe episode. We're in a very different point 6 months later. Unemployment is much lower than it was then. Obviously, we've got a long way to go, but unemployment was almost 15%. Today, it's just over 8%. The economy is overperforming certainly the Fed's expectations and that of most economists. Labor force participation is up. Wages are rising. Their retail sales have been strong. Housing starts are off the charts. There's a lot of encouraging data that's happening. And as I say, the program was designed to provide a short-term liquidity bridge for a fundamentally solvent business. Today, we're in a different place, and one of the challenges that I think we have to ask ourselves is, what do we do about the industries, maybe even sectors, where we probably have excess capacity, and we don't know for how long we're going to have it? How long is it going to take before airline travel resumes where it was in 2019? I don't think any of us knows for sure, but I don't think it's in the next few weeks. Likewise, what is the situation of the capacity in the hotel sector that has historically served business travelers? About restaurants. The Main Street program was not designed, was not intended to keep a sector afloat for months or years while we waited for demand to eventually come back. I think eventually demand will come back. But if we want to keep alive companies, broadly entire sectors where there's been tremendous demand destruction, then I think we have to ask ourselves whether this is the appropriate program to do it, and I would suggest it's not. I'd also point out that it's not reasonable to evaluate the Main Street Lending Program by the same metrics that we use for PPP. They're very, very different programs. One, we handed away money on the condition that you use it to keep your workforce intact. Of course, people are going to take up the money for that purpose. That was very successful for that purpose. The Main Street Lending Program served a different purpose. Now, having said all that, I do think there are some modifications that we ought to consider. Some have been addressed already. Professor Scott, for instance, and others have suggested that maybe the Fed should purchase 100% of the loans. I think that's worth considering, but there's an obvious challenge if we do that, and that is that the 5% retention that is required on these Main Street loans, retention by the banks that originate it, are meant to create an incentive for the banks to do a proper underwriting so that there is some limits to the amount of risk that is being taken here, because the idea was never to simply lend money to fundamentally insolvent businesses, but rather to lend money to cash-strapped businesses that are actually solvent. Some of the things I think we should consider is, and I think Professor Scott alluded to this, banks may not be the optimal vehicle for making slightly more higher credit risk loans. That is not their culture. That is not the regulatory mandate, even though the returns are outsized because the fees are so generous. it's the culture and the practice of banks to take a kind of binary approach to extending credit. And so maybe we should consider institutions like BDCs that might be better able to extend credit more broadly because they can take into account the higher return. A second thing I think we should consider is possibly upward limits on the EBITDA measures, especially in some places like early stage growth companies. I think the Fed should consider, and I have advocated considering, asset-based lending program, because it has been observed that there are categories of our economy where asset-based lending is the norm. I also think we should ease the affiliation standards. Remember, the Fed adopted the affiliation standards based really on the Small Business Administration programs, and it's not clear to me that that is suitable. So, Mr. Chairman, I appreciate this conversation. I appreciate having this hearing. I appreciate the thoughtful suggestions that are being made. I just wanted to provide that context, and with that, I will yield back my time.
Thank you, Senator Toomey. Senator Reed.
Well, thank you very much, Mr. Chairman. First, I have to recognize Professor Scott. Professor Scott was one of my professors at Harvard Law School. If occasionally I say something that's semi-intelligent, he gets the credit. The rest is all mine. But Professor, thank you for your wonderful testimony today. I also want to recognize Jeff DeBoer, who I've had the privilege to work with for many, many years. Thank you, Jeff. But I have some questions for Dr. Spriggs. Dr. Spriggs, I was particularly taken by your emphasis on the uncertainty which is plaguing the economy because of COVID. And one of the most uncertain aspects that I'm hearing about back in Rhode Island is just the status of jobs. People don't have the jobs, or people are on furlough, but they don't expect to be called back. We did have, as Senator Brown pointed out, a very, I think, appropriate unemployment compensation program. That is no longer on the books. We have to get it back on the books, in my view. But there's something else that seems to be happening, too, for uncertainty, particularly for working people, and that is the cost of living seems to be going up in essentials. The CPI has just shown that the price of pantry essentials, as they describe it, for example, flours increased by 4.5%, canned vegetables 6.4%, beans by 7.4%. So you're seeing not only the uncertainty of will I have a job, but also the uncertainty of will I be able to afford even basic essentials for my home. So Dr. Spriggs, does this make another case for a very aggressive unemployment compensation program?
Absolutely. It's the uncertainty that workers are facing that meant even with the $600, there was no disincentive to take a job. Workers are faced with such uncertainty around the job market that you can't refuse a job offer because it's not clear when the next one would occur. And as you're pointing out, the workers who are currently unemployed disproportionately are Black, Latino, Asian Americans. These are households with no wealth and no liquidity. The $600 is necessary to reassure them that they actually can spend because they are looking exactly at the issues you talked about, which is food security. So a smaller amount of money is not going to provide them with that comfort that I can spend now when they're looking down the road at increased food prices. And for households under stress, while the general CPI, the inflation rate may not be rising very much, they're really looking at those food prices. That's most immediate to them. And so that's why the $600 ends up being necessary. We didn't see a downside in terms of labor force participation. We saw every upside that was necessary to keep consumption flat. That was a remarkable achievement, and as Senator Brown pointed out, we are going to avoid a high level of poverty despite this economic calamity because of that.
Let me follow up too. In terms of uncertainty, is we've passed the first bill with a time limit and it ran out. And so if we do that again, I think people are going to be sitting back saying, you know, my job might not come back within the 10 months of this legislation. So I'm I'm okay, I'm better. So do you think it's important that we put in criteria so that we don't repeal the unemployment until financial conditions return, i.e. the unemployment rate comes down in a certain state to an acceptable level, something like that?
But we certainly shocked the household sector with Congress refusing to extend the need, even with a high unemployment rate, even with unemployment duration increasing, even with the shift in jobs from being temporary layoff to permanent layoff. And so, yes, you need to give the household sector a sense that Congress gets the message and understands the plight of the household sector so that they can return to some sense of normalcy. So hard deadlines that ignore the state of the economy are going to not, will not provide the certainty that households need to go back to spending.
Now, let me shift gears. So we're talking about uncertainty. I know the focal point is on the Federal Reserve program, but one other area in which the Fed really doesn't have the kind of the role to play is what the states are doing. And we created a coronavirus relief fund for the states. We gave them money. And that now seems to be in need of replenishment and more flexibility so they can spend it in different ways. Do you think that's appropriate, that we should put more money into the states to in fact, they might even be more flexible and more adaptable to dealing with some of these problems we've talked about, like homelessness and other things, than the Federal Reserve program that's going to be using banks to lend to traditional borrowers?
We have to give money to the states. That's not something the Fed can do. As Senator Toomey was pointing out in his comments to this, we didn't envision this was going to be a long-term problem. It's now lapsed over into the fiscal year change for state and local governments. They are going to implement austerity, and we need the state and local governments as partners in solving the COVID crisis. We can't have them withdraw from the field. We need them to give us safe schools and safe workplaces to return to. That's at the state and local level where people are confronting these issues. The Fed can't lend them the money. This is against the state constitutions. This has to be something that Congress addresses, and immediately, because we're in the new state and local government fiscal years.
Thank you very much, gentlemen, for your testimony. Thank you, Mr. Chairman, for your graciousness. Thank you.
Thank you. Senator Scott. I believe Senator Scott may have had to step away, and therefore we'll go to Senator Rounds. Senator?
Thank you, Mr. Chairman. Let me begin with a question for Mr. DeBoer. First of all, I want to say thank you to everybody just for participating today. Given the requirements associated with the Fed's Main Street lending facility and the challenges of taking on more debt, one alternative approach that has been suggested to assist businesses in need would be to allow Treasury to buy preferred equity stakes instead. This would be particularly helpful in sectors like hospitality and tourism that have high overhead and real estate expenses. It would also provide much needed capital without further stressing balance sheets. I understand that Congressman Van Taylor in the House and Senator Moran have been working on different but similar preferred equity approaches. My question, could you discuss the advantages and disadvantages of preferred equity purchases compared to the Main Street lending facility? Mr. DeBoer.
Thank you, Senator. As a native South Dakotan, it's great to see you, and best wishes to you. Let me just say that the preferred equity option comes up because typically for loans that hotel loans, restaurant loans, lodging loans, and so forth that are packaged in commercial mortgage-backed securities, those loans, those transactions cannot allow additional equity or additional debt to be put on them. They can only have equity. And so that's the advantage of using a preferred equity approach. The problem, as I see it, is simply whether a business wants to, in effect, give equity to the United States government in their business. And I'm not sure whether the appetite is really there. But I will say this, that the focus and the efforts by Congressman Taylor, by Senator Moran, by you and others in the Senate to look at this is very, very important. This problem won't go away. Some businesses have too much debt on them and can't take anymore. Some businesses don't have any more collateral or inventory to pledge for more loans. And as I said, some businesses' loans are tied up in a package, a pool, which won't allow any more debt. So we're very open to exploring this with you and other senators and members of Congress. Something has to be done to assist these businesses. I would say that I think that Senator Toomey is correct in saying that a lot of businesses can get traditional financing, but those who can't are really out on a limb and they have nowhere to go. And those businesses are the ones we just described: restaurants, retail space, hotels, real estate companies in certain senses of the word. And so I thank you for your focus and your question, sir.
Thank you. And I have just a real quick question for Mr. Scott. Just in listening to the discussions on the PPP program, Main Street businesses, larger, those that were not eligible. My question, why not take a look at the possibilities, since Republicans and Democrats both agreed that the PPP was successful and it allowed people to stay on payroll, their benefits continued on and so forth. What's the possibility that for some of those Main Street businesses that were restricted away from PPP because of their size, any value in looking at some sort of a PPP as an alternative for some of those larger Main Street businesses? And that would not only be able to take and keep workers on payroll, keep benefits in place, but may very well be able to allow those other larger businesses to stay in business and get through the next several months. Mr. Scott?
Yeah, Senator, I think the revised PPP or a renewed PPP should work side by side with a better Main Street facility. They're different in their terms. PPP is a forgiveness program, and PPP was designed for really small businesses, okay? The Main Street facility can be used by medium-sized businesses and is a lending facility. And when you look at the cost of one versus the other, obviously a forgiveness program is going to be more expensive, okay, than a lending program. We recommend that risk be increased under Main Street, but there's still loans that are being extended from the Fed to the private sector, and a lot of these loans will be repaid, okay? Under the forgiveness program, of course, you're forgiving the loan. So in my view, from the beginning, we had both of these programs working side by side, and we should continue that approach.
Thank you, Mr. Scott. Thank you, Mr. Chairman.
Thank you. Senator Menendez.
The Bureau of Labor Statistics last job report found that state and local governments have already laid off nearly 1.5 million public workers. If Congress doesn't act soon to help state and local governments, they're going to have to cut life-saving services, lay off or furlough more teachers, public safety, emergency health personnel, or raise taxes. So, Dr. Spriggs, let me ask you, if state and local governments continue to lay off workers, will that create a substantial drag on any economic recovery?
There will be a very substantial drag, and that's the headwind we face for the final 2 quarters of this year. And it's, again, dangerous for our economy. State and local government helps to support so much economic activity. And even if they don't cut more people, their cut in activity will hurt local businesses. But the number you cited is bigger than all of the jobs lost in state and local government during the entire Great Recession. These jobs aren't going to come back quickly. They're not going to bounce back unless Congress steps in to help state and local governments. The lesson learned from the Great Recession, unfortunately, at the state and local level, is that austerity is the wisest policy because Congress refuses to bail you out. If we have a national macroeconomic event, Congress ignores the problems that state and local governments face. So if you're a governor or a mayor, you will cut expenditures and you will be slow to reinvest. And we can't afford that. We need them to continue investment in K through 12 education and higher education, and as we see in our public health system. So we need them as active partners. Slowing them down threatens our economy tremendously.
Thank you. Mr. DeBoer, what would the impact be on the real estate industry if states, cities, counties had to cut investments in infrastructure and education, public health, safety, raise property taxes to continue paying for essential services?
Well, it would be, thank you, Senator, it would be bad. I mean, real estate and state governments, infrastructure are all intertwined. The health of real estate is critical to the local government's health, and the health of state and local governments are critical to real estate's health. So we're intertwined. And I maybe you were interrupted. I also wanted to say, because commercial real estate employs so many people, it pays so much taxes. In many cases, around 70% of local budgets are derived from revenue from commercial property taxes or transaction fees. As our marketplace deteriorates and can't get credit, and the tenants in our business deteriorate and can't get credit, that will put more pressure on what you're rightfully flagging for everyone is already a problem. And it could get worse as tenants are unable to pay rent, as landlords are unable to make debt service, and as values drop.
Yeah. And of course, in the real estate industry, the quality of life or the work environment is critically important. And these services go to the very essence of that in terms of adding value to where real estate property is located and what they can demand for price. Isn't that fair to say?
Absolutely fair to say, and I would add to it, given the current situation and the world we live in now, how states are able to help keep their transportation systems clean and healthy so that workers feel confident going to and from their place of business and so forth is very, very critical, and that's an added expense for state and local governments as well as businesses, by the way.
Dr. Spriggs, let me ask you, many of us have been disappointed by the ineffectiveness of the Fed's municipal liquidity facility. It would be a massive policy failure if we fail to get money into the hands of state and local governments, as we've just discussed, especially those who are the very epicenter of fighting the virus, which is critical. Currently, loans under the municipal liquidity facility would have to be paid back within 3 years. Wouldn't you agree that just like in the Great Recession, the fiscal pressures on states and localities are probably going to still be there several years beyond that?
Yes, the maturity on those loans has to be greater to really provide the smoothing of income that the state and local governments need. So extending the maturity and lowering the fees. The Fed is putting too high an interest payment on state and local governments through that facility.
Thank you. Thank you, Mr. Chairman.
Thank you. Senator Scott.
Thank you, Mr. Chairman, very much, and thank you to the panel for being with us this morning on a very important topic. I'll start with Mr. Scott asking you a couple of questions. One relates to the CDFIs and the important role that it plays in underserved communities and low-income communities. We've all seen the reports around the fact that we saw a 22% drop in businesses from February through April, and that's a significant drop in businesses. But when you think about Hispanic-owned businesses, it's 50% higher nearly. It's around 32% drop. And African-American businesses, about 100% higher, around 41, 42%. It seems to me that it's clear that it's imperative that our most vulnerable and underserved populations are not left out of the economic recovery. And it seems to me that CDFIs can play a significant role in providing that liquidity and access to the liquidity that so many of these community businesses desperately need. So Mr. Scott, what are some changes the Fed and Treasury should consider to better facilitate Main Street lending programs participation by CDFIs that serve these low income and underserved communities?
So, Senator, I agree with the thrust of your question and that we need to increase the role, but this is not something I've looked into, okay, in any detail.
Yes,
so
sir.
I'm really unable to give you a good response. What I would say is that we need to make funds available, by CDFIs as well as by the Fed we shouldn't abandon the Fed's role here. The Fed has tremendous capability. It's got the backing of the Treasury. It's got the ability to make loans if the program is correctly designed. And the problem up to now is that it's not designed correctly. We're asking banks to take credit risk, which they do not want to take. And the terms are not good enough for the neediest borrowers. They can't meet normal credit standards. Now, this is something the CDFIs could address. But I think, we should also focus on redesigning the Main Street facility as it now exists so the Fed can do more as well.
Well, Mr. Scott, you bring up a very important point around the redesign of the Main Street lending programs. I'd ask a question that when you look at the response to the last several months, larger firms have had access to assistance. Yeah, sure. Smaller firms have obviously had the Paycheck Protection Program, and if there's another bite at the apple, I think that would be wise. We've been flirting with the concept of a 20-year 1% loan up to $100 billion in that funds. But what seems to be obvious and missing is that mid-sized business and the lack of access to capital that they are experiencing. How do you think reducing the minimum loan size from the Main Street lending program from the $250,000 level, how would that create more access to resources for those mid-sized businesses? And relatedly, how might the Fed and Treasury reconsider the program's administrative fee models to better incentivize lenders and small service providers?
Well, I think decreasing the loan size would be really essential for the smallest businesses because I think that's where the loan size is. I think on the medium-sized businesses would probably need, at least $250,000 or more. It's not as big a problem. I think the problem for the mid-sized business is the general terms about how long the maturity is, how long they get to pay it back, what the interest rates are, etc. I think these are more the problems of the mid-size, and our committee has recommended a kind of realignment of those terms to make them more attractive to mid-sized businesses. By the way, I think Senator Toomey raised the point that maybe these mid-sized businesses don't need this facility because they can go to the private sector. Maybe that's true, maybe it's not. I doubt it because I think there's a lot of need out there for mid-sized businesses that is not being met, by the private sector. Under the committee's recommendations, we say that no borrower should be able to borrow from Main Street if they can get funding from the private sector. So Senator Toomey is right. We'll be okay.
Yeah. Well, let me use my last 12 seconds, Mr. DeBoer, to ask you a question that you won't have time to answer, but I'll ask you to answer it quickly. And that has to do with creating access for our commercial real estate market. There's no doubt that the leverage limit set forth in the Main Street lending program term sheets will not work for most commercial real estate companies. How can additional flexibility help create more resourcing of those commercial real estate companies and investors?
I'll try to be very quick, Senator. First of all, because the Treasury and the administration use the historic definition of a small business under the SBA loans for both the PPP and the Main Street lending program without any authorization or instruction from Congress to do so. They picked up these historic definitions. Those historic definitions redline out certain business activities, definitely including renting real estate, developing real estate, leasing real estate. So point number one, get rid of these inappropriate eligibility rules for both the PPP and the Main Street lending program. They have no application here. They shouldn't be allowed. And point number two is the affiliation rules. And this really isn't a real estate directly concern, but the affiliation rules, which have received so much publicity, certainly should not apply in the case of these mid-sized businesses, 5,000 to 10,000, as Congress has suggested. And then finally, you raise the the underwriting criteria. And again, certainly EBITDA has no place in an asset-based lending program, and it should be set aside. And finally, I would say this: if we're asking the Fed to make loans to businesses that otherwise can't get financing, which is what I think we all want, those loans are per se risky. And when a bank makes a per se risky business under current and normal operating conditions, regulators criticize it and mark it down and require more capital. Those things should be addressed here. We should be encouraging and incentivizing banks to make these loans where they're not right now. They're required to retain 5%. That's too much. They don't get paid enough to service the loans. That's no good. And they're open for criticism when they do make the per se risky loans that we always want them to make. I hope that answers it. I'm sorry for going long.
Thank you very much. I think we need more time, but maybe I'll have a second round. Thank you so much, Mr. Chairman, for your indulgences. Yeah.
I believe that Senator Crapo went to vote. Senator Tester's next.
Yeah, thank you, Senator Brown. I appreciate it very much, and I want to thank the witnesses for being here today. I want to refer back very quickly to Senator Reed's testimony when Senator Reed talked about the increases mainly in foodstuffs, and coronavirus has pointed out something else. As we've seen food prices go up in the grocery store, very little of that money has gone to the farm gate, and it points out the fact that we've got another problem in this country, and it's called consolidation in our processing, that we need to get fixed and fixed soon. Otherwise, our food chain for grocery store items is going to continue to demand that it goes up. Look, I have been concerned about the debt for a long, long time. I have watched this president in good times infuse about $1 trillion a year in borrowed money into this economy. And then brag about the fact the economy is doing really, really well when you see that kind of infusion when the previous administrations simply wasn't the case. Nonetheless, we are in difficult times right now, economically and with the pandemic. And we have to do things, and it's going to involve borrowing money. This question is for all the witnesses, and I'd like you to ask you to be as brief as possible. If you were in a position where you could say, I've got a couple, 2 or 3 programs that need to be funded absolutely unequivocally to keep our economy on track, where would you target those resources? And I'll start with you, Dr. Scott.
So I would target them kind of at, I think there are 3 targets here. There's the stimulus target, which I think Dr. Spriggs has talked about, getting money to individual people, okay? The second target is helping small business, and that should be done through 2 ways, both through the PPP program, maybe redesigned in some way, and through Main Street. So those are the 3 programs that I would focus on.
Thank you very much. Jeff DeBoer?
Yes, sir. Thank you for that question. I would first point out that the recommendations that I've made on the Main Street Lending Program and that I believe Dr. Scott has made really require no additional funds from the federal government. They are administrative. They could be done tomorrow by the Treasury and the Fed if they wanted to. Secondly, I would reload the PPP to help small businesses. And remember, in effect, that is a supplemental unemployment check too, because much of that money passes through to employees. And thirdly, I would set up a rental assistance fund for troubled residents and business tenants, so that if they could demonstrate severe economic hardship, they could tap those funds and pay their rent. The PPP could then use more of the money to pay payroll and utilities and taxes, and you'd have the Main Street program helping mid-sized businesses. And I think you would have a much better environment if you did those 3 things.
Dr. Spriggs?
Thank you, Senator. Well, we're at such a bad point with the disease. I would say we should think about what other countries did, which is to subsidize payroll directly and restore certainty to households about what's ahead. And we need to keep households that have lost jobs whole. But the number one thing we have to do is fight the virus. And we need far greater deployment of our resources at fighting the virus. We need to make sure that state and local governments have all the resources that they need. And we need to ramp up the hiring that it takes at the state and local level to do tracing, to do testing, to get the test in place, all of those things so that we can contain the virus and have state and local governments provide us with clean, safe transportation and maintain our transit systems. And as you rightly pointed out, Senator, we need this because we have to worry about competitive balance coming out of this. As you pointed out, we already have a problem with competitive balance. It's going to be worse coming out of this if we don't plan ahead on how we're going to maintain it.
Hey, man, a quick question for Jeff DeBoer. Jeff, right now there's no federal programs for rental assistance. And I do not believe there's any federal programs for folks who own rental property when those rents don't get paid. Could you just very briefly talk about the impacts if we don't do anything when folks can't pay their rent, and not only the folks that'll be put out on the street that can't pay their rent, but the folks who own the property that is the rental property? Because a lot of these owners are not rich corporations. They're families that may own a duplex or a fourplex that have rented it out for additional income or for retirement income. Could you talk about that just briefly?
Sure, Senator, thank you for the question. I think it's tremendously misunderstood what rent goes for and what it's used for. And the rent, what we call the rent obligation chain in the economy, is extremely important. And it begins with the renter, the business, or the person being able to put housing for themselves and their family, or to house their business. They pay the landlord. The landlord then pays for maintenance workers, for security workers, for other things to keep the building safe and healthy. It pays for the utilities. It pays for state and local taxes. It meets its debt service to the lenders. And the lenders, in turn, whether they're maybe they're banks, but they might also be pension funds or what have you. And those pension funds or banks in turn pay the bondholders or the pensioners a return. As this rent is not paid, the weakness will continue to erode the ability of owners to pay their payroll, to pay their taxes, to pay their debt service. Financial institutions will weaken. Pensioners won't get the return that they want. State and local governments will lose tax revenue because properties will be revalued in this new world that is based on rent receipts. If you don't receive rent, you don't really have much of a value. So this is extremely important with the underlying part of our economy. I appreciate very much. And Senator, I do want to thank you for co-sponsoring the Restart bill. A number of senators are co-sponsoring that bill by Senator Young and Senator Bennett. And that bill would do an awful lot of what you're talking about as well. For example, the conversation on CDFI. The Restart bill directly authorizes the use of CDFI to move this money through. So I thank you for that, and I thank you for the question.
Thanks, Jeff. Thank you, Mr. Chairman.
Thanks, Senator Chester. Senator Cotton is next.
Thank you, and gentlemen, thank you for appearing before the committee. At a time when we still have millions of working class Americans who are struggling because of major increases of unemployment and job insecurity due to the pandemic, Senator Schumer and Speaker Pelosi are currently demanding that Congress provide massive tax breaks for the rich. Namely, they want to repeal the limitations on the deduction for state and local income taxes. According to one study, 62% of the benefits of repealing that cap would go to the richest 1%, and 86% would go to the richest 5%. Repealing that $10,000 cap on the deduction for state and local taxes would result in a windfall for the richest 1% of more than $38,000. Professor Spriggs, given that 98% of the benefits of repealing the cap on state and local income tax deduction would go to the richest 20% of Americans, do you believe that Congress should include a repeal of that cap in any virus legislation that might pass?
Yes, Senator, I think Congress should. Some things that benefit the rich don't trickle down. This is an instance where the philosophy of state and local government comes into play. State and local governments often benefit those high-income families by not taxing them. The ability of state and local governments to raise taxes is threatened by this inability, and removing that lets state and local governments tax more efficiently. And so it may appear that they get a benefit, but it's on the other end that the rest of us benefit from higher revenues and higher investment in state and local government.
How many AFL-CIO members do you think are affected by the $10,000 cap on state and local taxes?
Well, our largest affiliate is AFSCME, those state and local workers who depend on having state and local governments have adequate revenues to make the investments that are necessary to sustain our local governments.
But how many
so they benefit directly because in those states that have very low tax rates, there aren't the resources to maintain proper public services and end up with lower investments. So our teachers, who are members of the American Federation of Teachers, depend highly on state and local governments making the proper investments. That takes revenue, and that means you have to be able to tax people in your community. So it removes a federal tax burden, but it allows state and local governments to put the tax where it needs to be.
How many AFL-CIO members on their own income tax returns are hurt by the $10,000 cap on the deduction for state and local taxes in your estimate?
I apologize, I can't give you the precise number, but in New York State, which is our largest AFSCME affiliate, a large share of them do in fact get hit by that because with overtime, there are members of some of the affiliates who aren't able to make the deduction. Some of them are high income workers.
Okay, so your position then is that Congress should repeal the cap on the deduction for state and local income taxes, which disproportionately benefits the rich, in any virus relief bill, so states and municipalities can raise taxes on their own citizens. Is that correct?
So that they can have progressive tax regimes, because otherwise it puts more pressure on taxes to be collected from those who are low income and middle income. That's the problem. So it's a shift in tax incident towards our members. Our members pay higher taxes because those at the high end don't pay the taxes that they should at the state and local level. State and local level taxes tend to be very regressive. This provision allows for greater progressivity at the state and local level.
Thank you, Professor. I think that was an illuminating conversation. Go back my time.
Thank you, Senator Brown. And let me just quickly add that one of the reasons that I think the state and local tax deduction issue comes up and is needed is because, unfortunately, proposals that have come from the White House and the proposals that have come from my Republican colleagues have been so skimpy towards giving relief to state and local governments during the middle of a pandemic. I'd simply point out that while we did get some funds in the first CARES bill, state and local government, there was, I think, a completely absurd restriction put on those funds that wouldn't allow it to be used for lost revenues. We gave billions of dollars for the airlines for lost revenues. We gave billions of dollars appropriately to small business for lost revenues. To somehow say a state and local government couldn't use the CARES dollars for lost revenues, I think was a policy mistake. And I think when you see some of the proposals that are coming forward that also exclude any additional assistance for state and local government, it's very disappointing. I've got a couple of questions. Mr. DeBoer, I want to start with you. I agree with a lot of the proposals in the Main Street fixes that you've put out. As somebody who was very involved in those negotiations along with Senator Brown and others, I was pretty disappointed with the ultimate facility, that it was not as flexible as we approach, and I think it left firms and workers really unable to take advantage of that program. You pointed out that hotels and retail have withstood some of the largest declines, and that actually then translates into if the landlords aren't paid, they can't make their debt service. That is going to really trickle into the CMBS market, and we could have a crisis similar to what we had in earlier decades. So if you want to spend a little bit of time, and I do want to get to CDFIs on some of your proposals around the preferred equity structure that you suggested, and if my understanding is that preferred equity structure of any ability to invest would really be irregardless of what kind of loan portfolio the developer real estate entity had. Is that correct?
Frankly, my proposal, Senator, and by the way, Senator, earlier I expressed my appreciation to your involvement on the Main Street lending program to begin with. It's a much needed thing. There are a variety of proposals on the preferred equity side of things. I think that my point of view here is that it should not apply to every potential borrower out there, but should be targeted to borrowers who have loans that are tied up in CMBS pools, because it is there that you cannot put additional debt. The borrower cannot assume additional debt on relative to those loans. That's where the program is needed. Again, I'm not an expert in this area, Senator. I'm sorry, and maybe I could get back to you with more.
If you could get back, I think, as we're trying to explore, while we give rental forbearance, which I think is appropriate at this point, if we simply push the problem up the food chain, we're going to have to grapple with it at some point. I want to take in my last minute or so and at least get to you, Dr. Spriggs. I think my friend Senator Tim Scott pointed out the question earlier. I've been working a lot on a structural change around investing into CDFIs. This pandemic has disproportionately hurt Black businesses, brown businesses. I've seen as many as 440,000 Black businesses close their doors, oftentimes because they weren't able to participate in PPP because they didn't have those long-term banking relationships. And I really want to thank Senator Brown and Senator Crapo and so many members on both sides of the aisle on this committee for working on the Jobs and Neighborhood Investment Act, which we've even found some support from the administration on. Part of that component, and this is where we're having some of the biggest rub, there seems to be a lot of consensus about the direct equity investment, but the ability to actually use a Fed 13.3 facility. Dr. Spriggs, do you believe that the Fed can and should, consistent with its mandate, better target minority community and through that CDFIs and MDIs? It's a relatively narrow piece of the financing pie, but when we're talking about a third of America being disproportionately hit, it seems to me that would be appropriate for the Fed. Dr. Spriggs, can you comment on that?
Yes, and the Fed has started to figure out a way that it can interface with the CDFIs. The problem is, as with the banks, it's a cultural problem. The Fed isn't used to dealing with the CDFIs. This is encouraging them to do it, and I think more encouragement from your office and from the Senate to have them do that is a good thing. We still have to address the underlying discrimination that has been revealed in the banking system. This is a serious problem. There is a Fair Credit Reporting, a Fair Credit Lending Act, and it needs to be enforced. We need equal access to capital. These are proper steps in the interim of getting the banking culture to be correct. But looking at our recovery, it's going to be vital that we figure out how do we get capital to the necessary sectors so we can have a balanced recovery. We can restore competitiveness in our system. And I think it will be important looking forward as we get out of this to think, how do we do this? Because if we just flood the capital markets, as we've seen here, that doesn't reach the people we need it to reach in order to get our competitive balance back.
Well, I want to just say thank you to that, Dr. Spriggs, and I want to thank all my colleagues on the committee on both sides of the aisle who've helped work with this. This would at least increase, it would help be short-term relief, but it would be structural change. It would be north, with the direct equity component, north of $100 billion of additional lending capacity. Thank you, Mr. Chairman.
Thank you, Senator Warner. And I want to thank Senator Brown for covering while I went to vote. And Senator Kennedy, you're next.
Mr. Chairman, can you hear me okay?
We hear you. Yep.
Mr. Chairman,
Yes. Can you hear us?
I can hear you.
We can hear you. Go ahead.
Well, my little earbud thing's on.
I've listened, gentlemen, I've listened to the testimony with interest. I gather that all three of our witnesses are suggesting that Congress provide more relief. In the first four bills, I think we spent a little over $3 trillion. I voted for those bills. Did we do the right thing? I think we did, but we won't know until we have the benefit of hindsight. One thing I think we all can agree on is that our debt now is staggering at $26 trillion. Mr. DeBoer, how do you suggest Congress reduce this debt?
Well, first of all, let me just say that, again, the administrative changes that we're suggesting for the Main Street program will not cost the federal government any more money. It's already been, okay. So you've spent that, let's make it work. As far as the deficit and debt going forward, I think this is an extremely serious problem, and our industry, which is very interest rate sensitive, is very concerned over time about the deficit. I believe that it's...
How do you think we should reduce it?
Well, right now, I don't think now is the time to reduce it. I think now is the time.
How do you think we should reduce it?
When the time comes, sir, when the time comes, I think that revenue options need to all be on the table, and I think spending reduction options need to be all on the table. But again, right now, this economy is teetering on the edge and needs assistance.
I get it. Let me move to Mr. Scott. What do you think, Mr. Scott? How do you think we ought to reduce this debt once the time comes? Spending. I think we've got that part. Senator, I totally agree with your concern. We need to reduce debt in the future, okay? But I agree with Mr. DeBoer that now is not the time to do it. How we do it in the future really depends on the situation of when our economy does recover in the future. And I think it's important that we work now to make it recover. Revenues will increase, tax revenues will increase, and that will have a major impact on the reduction of the deficit. Let me ask you a question, Mr. Scott. How much more do you think we can borrow until we get into dangerous territory? That's a very hard question. I think usually the dangerous territory is inflation. And, we are living in a very anti-inflationary environment and have been so for some time. So, it's not apparent. The debt service cost today is obviously much less than it would be if we have more inflation. So we need to keep our eye on that issue. Let me stop you, Mr. Scott. Here's what I'm trying to get to. You're all very accomplished professionals, but I'm looking for your expertise. I get the idea that by raising revenue or lowering costs, we can take care of the deficit. I get that part. How do we do that? We get advice every day to spend more money. The obvious question is, and I'm not saying we shouldn't, but at how much more? At what point do we get in dangerous territory? I understand the Phillips curve may be losing credibility, but at what point do you think if we spend this money, inflation will come back? At what point, if we keep borrowing money, will we undermine the sanctity of the dollar? That's what I'm looking for, as opposed to just general concepts. How about you, Professor? How do you think we ought to pay this money back?
Is that directed to me, Senator?
Yes, sir, Professor. I'm sorry.
Well, this is a war. We are in a war with the virus. This is the last time we had debts at this level was when we were in World War II. And in a crisis setting, we don't want to create the uncertainty that we lack seriousness in winning the war. So we don't want people to think that we're going to back away from getting the virus under control. And I think that premature discussions make people believe we don't want to win.
Professor, I get all that. How do you think we ought to pay this money back?
We paid down the debt of World War II, which was, and we're getting close to equivalent to that, by ensuring that we had rising wages, rising productivity, but most importantly, rising wages. And then, as Mr. Scott said, we had increased revenues because we had broad-based, broadly shared economic recovery, and we had much different tax rates. We had tax rates that had much higher levels at the top. That's how we paid down the debt of World War II. And we have to be thinking about an economy that can generate that kind of broad income growth as we saw after World War II. So we have to institute those institutions that ensure that wages of workers are rising with productivity. We have to increase the minimum wage. We have to give workers back the power to organize. We have to do those things that were in place in the 1950s so that we can see incomes rise dramatically.
Right. Okay, thanks.
Senator Van Hollen.
Thank you, Mr. Chairman, and thank all the witnesses. Let me start with Dr. Spriggs. We know that there's been a lot of discussion about putting in place eviction moratoriums, both at the state level and the national level. Of course, the House HEROES Act has an evictions moratorium. The Trump administration has attempted to put in place some form of a moratorium, and I don't think any of us want to see tenants evicted at any time, but during this pandemic would be especially dangerous. However, I think many of you have testified to the fact that that simply kicks the can down the road. In the end, tenants are still going to have to make their rent obligations. They'll have to face a balloon payment at the end, which, given the current trajectory, people are not going to be able to afford. Which is why the ranking member, Senator Brown, and myself and others put in legislation for emergency rental assistance. The House HEROES Act also has the rental assistance provision. Dr. Spriggs, can you talk a little bit about, the fact that an eviction moratorium without that additional rental assistance help simply puts tenants in an untenable position at the end of the road, and immediately, as others have said, including Mr. DeBoer's, puts the landlords who have their own debts to pay in a difficult position. Can you talk to that?
Yes, Senator, and exactly the point that Mr. DeBoer has been raising. We stem off a financial crisis by making sure that people are making the payments they're supposed to make and help out the balance sheet in that way. And as you said, an eviction moratorium is good because we don't want homelessness, but we need the support for people to pay the rent. We need landlords to get their money. We need shopkeepers to have money so they can pay their rents. And this is the important thing for us to get ahead of the game rather than wait for foreclosures to take place and banks to be in trouble. So this is a foot race, and we're losing the foot race because the debts are mounting and we're not letting individuals get ahead of the race on that debt level. That is what has to take place. And without that, we're going to get to January and we will find banks having problems because the landlords have problems. And the loans that the landlords are paying will be in default.
Right. Mr. DeBoer, can you comment quickly? There's a vote on. I'm going to have to run, but this seems to be an area of common ground, and I wish there was broader recognition that getting funds into the hands of tenants, to pay their landlords on the residential side, but also, as you pointed out, on the commercial side, is something that would be very important at this moment.
Yes, and it's only going to get worse. The Multi-Housing Council has their numbers out on rent payments for this month. They've dropped another 5%. So, and that, of course, is connected with the burning off of federal assistance. So that problem is only going to get worse. And you correctly point out that the moratorium does not solve the problem. It creates a bigger problem once the moratorium is lifted without rental assistance. So I very much favor rental assistance. And I think these moratoriums, to the extent that they're done, and some have been overly broad, to the extent that they're done, they should only apply to residents who have some economic hardship due to the COVID. They shouldn't be blanket moratoriums on eviction. So thank you for that. And I would also add on, I didn't mean to speak over Senator Kennedy. That was rude. And I just want to, I was trying to get to the.
I'm gonna unfortunately, Jeff, I gotta run and vote now. But I want to thank all of you. We have some common ground on rental assistance. Take care.
Thank you. Senator Cortez Masto.
Thank you. Gentlemen, thank you. This has been a great conversation. Dr. Spriggs, let me start with you. In your testimony, you noted that the greatest job losses in April, almost 8 million, were in the leisure and hospitality industry. Obviously, Nevada being hardest hit and a major concern of ours as well. So let me ask you this. What policy mechanisms and tools can Congress prescribe for a swift recovery for those industries and workers who are hardest hit and will undoubtedly take the longest to recover?
The first thing we have to do is get very serious about fighting the virus so that people can feel comfortable in returning to normal economic activity. Mm-hmm. That's number one. And all efforts have to be directed at giving us an assurance that we are in a serious fight to get the virus under control so we can have safe travel and feel confident that we can stay safely in hotels, and businesses feel comfortable with having their representatives out on the road without returning and infecting their workforce. So that is number one. We have to maintain the incomes of workers now so that when we do have that relief, people aren't heavily indebted and trying to balance their household sheets, and that will delay their ability to return to travel. And Congress is going to have to pay great attention as we come out of this to competitiveness balance. We need a vital transit system. We need to have airlines back functioning. We have to have tourism working. That's one of our greatest sources of trade balance, is through our tourism, through foreign students who come to the United States. And we have to think through how are we going to restore competitiveness balance as we come out of this. Americans don't have paid leave. The rest of the world, August is vacation month. It's not in the United States. We have to give serious consideration to how are we going to do this with a workforce that doesn't get leave. There are a number of steps that we need to start considering now so that we're in agreement as we come out of this to restore balance to these industries.
Dr. Spriggs, thank you. And thank you, all three of you. I appreciate your comments to Senator Tester's question about what we need to do, because it goes back to what you just said, Dr. Spriggs, the balance. We've got to look to assure that individuals are receiving relief, businesses are receiving relief, everybody should be receiving relief right now, nobody should be left behind. And that's why I appreciate this conversation, because I think we also, part of this is how we address the concerns for some of our mid-sized businesses, large businesses, and our smaller businesses as well. Because at the end of the day, you need the businesses to employ the workers, and you need the workers for the businesses. They go hand in hand. So, Mr. DeBoer, and thank you for your conversation as well. You made the comment that Main Street lending facilities, we don't need to invest any more money or inject any more money into it. What we need is structural change. And I think I've heard that consistently from all of you. But let me ask you this, and I agree with you. I think there needs to be structural change. Would you support, though, clawing back any of the unused money in the Main Street lending facilities? Or do you think it should still be there to be used as part of this restructuring?
Frankly, I think it should be given an opportunity to work the way that Congress wanted it to work. And you've given the money, it's been a hamstrung. You should take off those restrictions and let it work. Because these businesses, whether you claw it back or not, these businesses need assistance, and this is the only program geared to provide them. So I would favor keeping the program. I would make it work, though. I would use that money.
So what if we were to put a bill on the floor of the Senate this week that actually says that money that is unused should be clawed back beginning next year? What kind of signal is that sending to businesses in general about where we stand or what we're thinking here in Congress?
Well, I think the signal is many signals. One of them is that there's not the will to force the regulators to make the program work the way that you intended it to work. And I think that's a bad signal. But again, if you can only do some things, you've got to do what you can get done. I also think that people understand that this bill is a part of the legislative process, and that as it moves along, that hopefully, you know, the PPP can be recapitalized and this money can stay at Main Street. So I'm not sure that this one vote or bill on the floor is the end of the world. I would also say it's a pleasure to be here with Dr. Spriggs. Frequently, business and employees and workers are viewed by the press and others as being in conflict. We're not in conflict. We work together with our workers, with our employees, and it's great to have the points of view articulated by Mr. Spriggs here today. Thank you.
Well, and let me just say this. I didn't get it from the conversation that we had today. I don't think any of you are in disagreement. I think the goal here is everybody is in agreement that there needs to be another comprehensive package. We all have to be thinking about the relief in a comprehensive manner here. Nobody should be picking, choosing winners and losers.
But by the way, we've talked a lot about opportunities, and all of us, I think, have opened our eyes wider to the lack of opportunities that certain parts of our economy and country have. And it is worth noting that since the COVID crisis started, 5% of businesses owned by white business owners have failed, while 19% of businesses owned by black owners have failed. That's not right. And many of those businesses are these Main Street businesses that currently cannot get this access to financing. And that's just another reason why I would put that money to work downtown and not let it sit idly in a vault somewhere.
Thank you.
Thank you. Senator Jones.
Thank you, Mr. Chairman. Thank you to all our witnesses. I really appreciate it. Mr. DeBoer, I'd like to just kind of follow up on that last comment. First of all, let me thank you. You and the realtors have been very helpful with my staff and offices on a number of things that we've been successful on and others that we're thinking about. So thank you personally for the work that we've done together. But I'd like to follow up on that question for you and the other panelists to weigh in, and that is access to capital. We have seen that early on, minority businesses had trouble accessing the PPP program. I haven't seen the latest statistics on that, but we had to make some carve-outs to help with that. We have seen the businesses fail. As you mentioned, 19% of black-owned businesses have failed as to compared to only 5% of their white counterparts. I understand you taking some of the money that we have that is left over to maybe help infuse and actually stimulate those businesses. But this is a long-term problem. This is not something that the pandemic caused. You know, minority businesses and the struggles that they have are really they've been ongoing for a long time, and the pandemic just put a spotlight on those. So how best going forward can we ensure that minority businesses have access to capital? How can we ensure that they are as structurally strong as their white counterparts? And I'd like to ask, I'll start with you, Mr. DeBoer, since you just mentioned it, but I'd like to get the others to weigh in as well on this question. I think it's incredibly important for America.
Senator, it is incredibly important, and I will be very brief. It's a complicated and it's a long-term answer to how we address the problem that you've described. But one thing that you might consider, and I, again, don't want to say it's the greatest, well, let me just put it this way. Senator Menendez has a bill dealing with, that would encourage businesses to provide, and they would be measured more by the types of opportunities and investments that they make in into minority women and veteran-owned businesses, and having a benchmark, a structure, a metric that people could and businesses could be measured against in that bill. And the bill also passed the House, I believe. Congressman Meeks put a bipartisan bill over there. I think having something that businesses would be measured on in their ESG statements or in their filings to the SEC would be very, very helpful in this regard. And I want to tell you that my experience talking to CEOs around the country in a variety of businesses, everyone seems aware and intent and focused on doing what they can do to address this problem. We'll see, but they certainly seem to be willing right now.
So Senator,
please.
I think it's imperative that if we have government programs to support our economy, that they reach, minority businesses or minority people. Many of the people are unaware of these programs, okay? So we have to do a much better job of reaching out, okay? And our committee has advocated that any revised Main Street program do so. And I would generalize that point, okay, to all government programs that we have. Part of the problem is that the government is not reaching out sufficiently to make these programs known in many of our communities. So that's one practical step I think we could take.
Great. Dr. Spriggs.
Thank you so much for the question, Senator. And yes, this is now raised to, you see a consensus among a panel of business and labor economists on this point. The government can play its own role through its contracting. The government needs to debundle as many contracts as possible so that it's the government doing direct contracting rather than having subcontracts. This will ensure that the government knows that it's maintaining competitive balance in our economy and gives greater access to minority-owned firms because they get to deal directly with the government rather than having to deal with these bundled contracts. Business-to-business contracting is the greatest level of discrimination that takes place in our economy. And this has revealed the discrimination within the banking system. The Federal Reserve has to be held far more accountable for its responsibility in ensuring there is not discrimination in lending. And what this has shown is that banks do discriminate, and that has to stop. And the Fed has to be questioned repeatedly about what steps it is taking to monitor that. We have eye on mortgage lending through the Federal Home Mortgage Data System. We need a system similar for business lending so that we make sure that there's reporting and accountability on that level. And when Congress hears from the Fed chair, to make sure that's part of what he responds to, is how inclusive is our banking system in making these loans available, broadly speaking. And we need business to step forward in looking at its supply chains. There is a National Minority Supplier Council, and we need businesses to be participating in it and holding themselves accountable as we hold the government accountable through changing its contracting and making sure that they're using small and minority businesses as much as possible.
Dr. Spriggs, thank you for that. And I know my time is running out. I can't see the clock, but I'd like to call everyone's attention, both my colleagues as well as this panel, to a program that was started by Mayor Woodfin in Birmingham with some of the largest companies in Birmingham, Alabama. And it does just that. It recognizes that every business has to seek minority vendors, minority-owned businesses, bring in folks on their board, and also be more transparent and mentoring. I think the private sector has a role in this as well as the public sector. So thank you all. And Mr. Chairman, I probably have gone over time, which I apologize, but I can't see the clock. So thank you very much, Mr. Chairman.
Thank you. We'll make sure we get that clock right on your screen next time. That concludes the senator. Senator Brown has asked if he could ask one more question, and then we're going to have to run to our next vote, which should be starting any second now. So Senator Brown, please go ahead.
Thank you, Mr. Chairman, for doing that. And I was really taken today by, three people came in with differing views on a lot of things, and there's a broad agreement that we need, obviously, a real stimulus package. My only question, it's really a yes or no for Professor Scott. You think Congress providing direct help to households is critical for helping the economy recover, correct? His sound isn't on.
I gotta unmute myself. Okay, the answer is yes.
Thank you. And I was taken, as I've pointed out, that Mr. DeBoer, who came in here representing businesses, obviously also spoke repeatedly about rental assistance. So, Mr. Chairman, there's brought in, of course, Dr. Spriggs is making the case, the main part of his testimony about unemployment insurance and local government assistance and others. So there's broad agreement the economy's in trouble. The best way to address it is through direct help to households. It means unemployment insurance. It means rental assistance. It means support for state and local governments. The House has already passed a bill back in May, as we know, that would take care of workers and renters and homeowners and students and seniors and veterans. We should act on that bill, but all the economic support in the world can't solve our problems if the president doesn't start taking the coronavirus seriously. It might be uncomfortable, but it's time for my Republican colleagues here in Congress, especially in the Senate, to hold the president accountable, to speak to Senator McConnell, who said he saw no urgency in this, to speak to him, to hold the president accountable, despite the president's continued attempt at gaslighting the country. Everybody in this committee, everybody in the Senate understands the pandemic won't go away just because we decide to ignore it. So thank you, Mr. Chair.
Thank you. And that does conclude the questioning for today's hearing. Again, I want to thank each of our witnesses for your counsel today and for being willing to come and discuss this important issue with us. For senators who wish to submit questions for the record, those questions are due to the committee by Wednesday, September 16. And to the witnesses, we ask that you respond to these questions as quickly as you can after you receive them. Again, we appreciate you being here, and this hearing is adjourned.
Thank you all. Good to see you all. Thanks, all three of you.
Thank you, Mr. Chairman.